There is a compliance obligation sitting inside almost every financial institution's AML framework, one that most teams have never properly assessed, never stress tested, and in many cases they barely understand. It's called Proliferation Financing, and according to FATF, only 16% of countries assessed globally have demonstrated high or substantial effectiveness in countering it. This is not a niche topic for weapons experts or government agencies. If you work in AML, in sanctions, in KYC and compliance for bank, payments firm, crypto exchanges or insurance companies, this affects you directly, and in this video I will break down exactly what proliferation financing is, why it's different from traditional anti-money laundering and sanctions works, and what are your obligations. Also, what red flags you need to know. So it's time to jump into today's video. Let's start with a clear definition, because this is where a lot of confusion begins. Proliferation financing is the act of providing funds, financial services or economic resources directly or indirectly to support the development, acquisition, production or transfer of weapons of mass destruction, nuclear, chemical, biological or radiological weapons, including their delivery systems. The key word here is financing. So we're not talking about the manufacturing of those weapons, it's about the money flows that makes those programs possible. The two main actors of concern as set out in the UN Security Council resolutions are North Korea, which is actively developing nuclear and ballistic missile capabilities in violation of multiple UN resolutions, and of course Iran, which was subject to targeted financial sanctions, still subject to it, related to its ballistic missile program. But proliferation financing isn't just about government programs, it's also including non-state actors attempting to acquire weapons of mass destruction, related materials, technology and knowledge. This is the question I hear most often, and it's a fair one. You might think we already do sanctions screening, aren't we already covered? Well, not quite. Here is the key distinction. Standard sanction screening asks if this customer or transaction name matching a designated individual or an entity on a list. Proliferation financing asks something broader and harder. Could this customer, transaction or business relationship be part of a network that is directly or indirectly financing a weapon of mass destruction program, even if no name on our list is actually involved? The FATF is explicit on this. Under Recommendation 7, the obligation is to implement targeted financial sanctions, freeze assets or designated parties with no exception, and no risk-based simplification. But under the October 2020 amendment to Recommendation 1, a separate and additional obligation was introduced. Financial institutions and DNFBPs must now identify, assess, understand and mitigate their proliferation financing risk. This is a risk-based obligation that's sitting alongside, not replacing, the strict R.7 requirements. In plain terms, you need both. You need to screen properly against lists, and you need to understand whether your business model, customer base or geographic exposure creates pathways that proliferation networks could actually exploit. Here is a number that should get everyone's attention. Only 16% of countries that are assessed by FATF and its global network have demonstrated high or substantial effectiveness in immediate outcome 11, which measure how well countries implement targeted financial sanctions against the proliferation. That means 84% of jurisdictions are failing short. And the threat is not abstract. In February 2025, North Korea stole $1.5 billion from Bybit, a crypto exchange, using cyber attacks as part of its weapon of mass destruction revenue generating strategy. The same FATF report identifies 4 major typologies under proliferation financing sanctions evasions today: shell companies and complex ownership structures to obscure beneficial ownership, Trade-based method using dual-use goods, legitimate items with potential weapon of mass destruction applications. Procurement networks using from companies and third country intermediaries, and virtual assets exploited for revenue generation and moving funds across borders. So these aren't hypothetical scenarios, they are documented active evasions and methods that are in use today. So what are you actually required to do? Let me walk through the framework more clearly. The obligation number 1, implement targeted financial sanctions as part of Recommendation 7. This is mandatory, no exception, no risk-based simplification. You must freeze without delay any funds or assets belonging to or for the benefit of any person or entities that are designated under relevant UN Security Council resolution. The key resolutions are UN SCR 1718 and its successor resolutions relating to North Korea, and UN SCR 2231 and related resolutions related to Iran ballistic missile program. Financial institutions must also report to competent authorities any assets frozen or suspected attempted transactions. Obligation number 2, conduct a proliferation financing risk assessment, part of Recommendation 1. This is the newer obligation introduced in October 2020 and still catching many institutions off guard. You must assess the degree to which your business could be exploited by proliferation network. This means looking at your customer base, other sectors or geographies with higher proliferation financing exposure. Your products and services. Could trade finance, correspondent banking, or virtual asset services be misused? Your geographic footprint. Do you have exposure to those jurisdictions that could be linked to weapon of mass destruction programs? Your transaction patterns. Are you seeing unusual activities linked to dual-use goods or procurement networks? Let me make this operational. What does a proliferation financing risk indicator actually look in practice? The FATF guidance provides a set of indicators organized into 4 categories. Here are the most practical relevant ones for financial institutions. Customer-related indicators. Customers in sectors that produce, sell, or ship dual-use goods, electronics, chemicals, aerospace components, advanced material. Customers with opaque ownership structures involving jurisdictions that could be linked to DPRK or Iran. Customers who are reluctant to provide information about end users of goods or services. Transactions-related indicators. Payments to or from third countries intermediaries with no obvious commercial rationale. Inconsistency between declared goods and payment amounts. Classic BML overlaps. Use of multiple currencies or jurisdiction hopping with no clear business reasons. Payment referencing. Government entities in DPRK or Iran, even though intermediaries. Geographic indicators. Transactions routed through jurisdictions known to support weapon of mass destruction programs or under UN sanctions. IP addresses or device locations inconsistent with customer stated location. Virtual asset specific indicator. Funds flowing through DPRK linked crypto addresses. The Lazarus Group is the primary threat actor here. Use of mixers or acronymized services to obscure funds origins. One of the hardest parts of proliferation financing compliance for financial institutions is the concept of dual-use goods. These are items that have legitimate commercial application but can also be used in weapon of mass destruction programs. Think like this: high-precision machine tools, electronic components used in guidance system, chemicals precursor, certain biological research equipment. A payment for one of these items might look completely normal on the surface. The question is whether the end user, the destination, and the declared purpose are consistent, and whether there are red flags suggesting the goods are destined somewhere other than where stated. This is where the overlap between trade finance team and anti-money laundering as well as sanctions team becomes critical, and it's an area where many institutions have genuine blind spots. Based on the FATF assessment and the industry guidance available, here are the most common gaps. Most institutions have an AML CTF risk assessment, but very few have adequately incorporated proliferation financing risk as a distinct and separate analyzed component, treating proliferation financing as purely a sanction screening problem, and sanction screening handle R.7, the design person list, but R.1 requires you to think about the risk of evasion, not just the confirmed match. So these are fundamentally different questions. No escalations or detection protocols for dual-use goods. If your transaction monitoring rules aren't calibrated to flag unusual patterns in sectors that handle dual-use goods, you have a gap. Poor understanding at senior management level. Boards and senior management are accountable for ensuring the institution understands and mitigates its proliferation financing risks. In many firms, this has never been presented clearly at that level. Now, if this is making you think, I need to understand financial crime risk more deeply, not just at the rule level, but the operational level, that's exactly what the FinCrime Career Accelerator is built for. It's a self-paced program that takes you inside how financial crime teams actually operate. Sanctions, FAU, CDD, MI, and reporting, and help you develop the professional judgment that separates analysts who understand the rules from those who understand the risk. And you can find out more on the link that you will find in here and in the video description right below. Here is a practical roadmap for AML and compliance professionals. Step 1. Review whether your risk assessment covers proliferation financing as a distinct risk, not just a paragraph within your AML risk assessment. Step 2. Map your customer base against proliferation financing sensitive sectors, trade finance clients, manufacturers, logistics providers, technology distributors. Assess whether any of these have exposure to dual-use goods or operate in high-risk jurisdictions. Step number 3. Calibrate your transaction monitoring for proliferation financing indicators. Review whether your existing rules would flag the indicators we discussed, and if not, consider whether additional scenarios might be needed. Step 4. Ensure your sanction screening covers all relevant UNSCRs for DPRK and Iran are the primary designation under proliferation financing related UNSCRs, and confirm that your screening tools and lists are comprehensive and current. Step 5. Brief your senior management and board for proliferation financing is a governance level accountability. Boards need to know that these obligations exist, what the current threat landscape looks like, and what the institution is doing about that. Time to wrap up. Proliferation financing is the financing of weapons of mass destruction programs, and it's a distinct compliance obligation separate from your standard AML and sanctions work. Under FATF Recommendation 7, targeted financial sanctions against a designated person and entities are mandatory with zero flexibility. Under the 2020 amendments to Recommendation 1, institutions must also assess and mitigate the proliferation financing risk, a risk-based obligation on top of strict R.7 requirement. Only 17% of countries globally are demonstrating effective implementation, meaning this is an area under increasing regulatory scrutiny, and the most common gaps are no standard proliferation financing risk assessment, treating proliferation financing as only a screening problem, and no detection protocols for dual-use goods. If you found this video helpful, do press the like button and subscribe for more practical insights into anti-money laundering, sanctions, and financial crime compliance. So that's all for today. It was a bit of a long video, but thanks for watching, and I will see you in the next one.